What happens when two of the most iconic investors in history, Bill Ackman and Warren Buffett, look at the same company and come to completely different conclusions? One says it's a lifetime opportunity, while the other walked away years ago. That's exactly what's happening with Nike. Bill Ackman made headlines when he doubled his investment in Nike last quarter, calling it a long-term opportunity too good to pass up. But back in 2010, Buffett and his partner Charlie Munger famously exited their position, citing concerns about understanding Nike's competitive advantage over the long haul. So, what has changed? Has Nike evolved into a company with stronger fundamentals and a clearer growth trajectory, or is Ackman taking a risk? In this video, I will show you why Ackman sees Nike as a lifetime opportunity, revisit Buffett's rationale for selling, and analyze Nike's current intrinsic value. And should you be buying it? Let's start with the basics. Bill Ackman and Warren Buffett both might wear the value investor badge, but they're playing completely different games. Think of Buffett as the steady marathon runner, always pacing himself, never taking unnecessary risks. Ackman, he's more like the guy sprinting for gold, taking calculated risks that sometimes pay off big. Buffett's relationship with Nike is a classic example of his investing philosophy. Back in 2010, he sold his stake in the company, not because he thought Nike was a bad business, but because it didn't check all his boxes. Here's Buffett in his own words.
I'm not expressing a negative view in any way on that. I don't understand I don't understand their competitive position and the likelihood of permanence of their competitive position over a 10 or 20-year period, as well as I think I understand the position of Brown and Dexter. That doesn't mean I think that it's inferior. It doesn't mean that I think that we've got better businesses or anything.
Translation? He wasn't confident he could predict Nike's future the way he could with companies like Coca-Cola or Gillette, which dominate their markets with a more straightforward business model. For Buffett, if it's not simple, it's not worth the risk. Now, fast forward to today, and here comes Bill Ackman grabbing up Nike shares faster than a sneakerhead on release day. Why? Ackman's strategy often focuses on undervalued companies with strong growth potential. He's not afraid of a little complexity if he sees a clear path to success. For Ackman, Nike's brand, global reach, and pivot to direct-to-consumer sales are probably screaming opportunities. But here's the twist. Both investors are technically right. Buffett's approach is about avoiding mistakes. He'd rather pass on a good investment than risk a bad one. Ackman, on the other hand, is willing to dive deeper into businesses that might require a bit more work to understand fully.
Some businesses are a lot easier to understand than others. And Charlie and I don't like difficult problems. I mean, if something is hard to figure, we'd rather multiply by 3 than by pi. I mean, it's just easier for us. Yeah.
Let's break down the numbers, because if there's one thing Buffett and Ackman both agree on, it's that a company's value has to be rooted in solid math. Value investing is all about figuring out a company's intrinsic worth and comparing it to the stock price. Think of intrinsic value as the true worth of a company, regardless of what the stock market says. It's like figuring out what you'd personally pay for a car based on how much you'll use it, its condition, and how much value it'll give you over time. For a company, intrinsic value boils down to the cash it's expected to generate in the future. If a stock is trading below its intrinsic value, it might be a good deal. If it's trading above, it could be overpriced. So how does Nike stack up? Nike isn't just a company, it's a global icon. Last year, Nike reported an impressive $51 billion in revenue, growing at a solid 10% year over year. This growth is largely due to the company's strategic shift towards direct-to-consumer sales. More on that later. To understand whether Nike is a good investment today, we can use a discounted cash flow analysis. This method estimates a company's intrinsic value by calculating the present value of its future cash flows. Using Nike's current free cash flow of $6.7 billion, a conservative annual growth rate of 7%, and a discount rate of 10%, Nike's intrinsic value is estimated to be approximately $88 per share. However, with the stock currently trading at $75.67 per share, it appears to be undervalued by roughly 14% relative to its intrinsic value. For a value investor like Warren Buffett, this modest margin of safety still might not be sufficient, as he typically looks for a significant discount to intrinsic value to account for potential risks or for businesses he thinks are complicated. In fact, in the last quarter, he increased his position in Nike by 435%, adding over 13 million new shares. At the core of his bullish stance is Nike's evolving business model, financial strength, and untapped potential for global growth. With the company's free cash flow now at $6.7 billion, Nike's intrinsic value has climbed to an estimated $88 per share, making its current stock price of $75 look like a bargain. For Ackman, this is a calculated bet on a company poised for long-term growth. One of the most compelling aspects of Nike's transformation is its direct-to-consumer strategy. Currently, DTC sales account for over 40% of Nike's total revenue, a significant jump from less than 20% a decade ago. By bypassing third-party retailers, Nike has dramatically boosted its profit margins, which now stand at 44.6%. By owning its customer relationships, Nike can better tailor its offerings, build loyalty, and adapt to changing consumer preferences. Ackman likely sees this as a critical competitive advantage, positioning Nike to thrive in a rapidly changing retail landscape. Nike's brand power is another factor for driving Ackman's optimism. Few companies can match Nike's cultural impact and market dominance. It has an ability to command premium pricing, even during economic downturns. Nike achieved 10% year-over-year revenue growth, reaching a record-breaking $51 billion in revenue. Emerging markets further enhanced Nike's growth story. Nike reported a 6% revenue increase in Greater China in the last quarter, totaling $2.08 billion and accounting for 18% of total sales. Emerging markets, including China and India, contributed approximately $6.7 billion in fiscal 2024, driven by rising disposable incomes and urbanization. These markets present significant growth opportunities as demand for premium brands like Nike continues to rise, offering a hedge against slower growth in mature regions. For investors like Ackman, this positions Nike as a strong player for long-term global expansion. To understand whether Warren Buffett was right to sell Nike in 2010, we need to revisit the financial landscape and the company's strategic position at the time, comparing it to today's updated data. Buffett's decision wasn't about disliking Nike, it was about his preference for simple, predictable businesses with a clear margin of safety. But how do the numbers and transformations over the years reflect on his decision? In 2010, Nike was a global leader in the sportswear market, with revenue of approximately $19 billion and net income of $1.9 billion, representing a 10% net margin. Free cash flow stood at around $1.7 billion. However, Nike's business model then was heavily reliant on wholesale distribution, with the majority of sales going through third-party retailers. This limited its control over pricing, customer relationships, and ultimately its margins. Direct-to-consumer sales were only a small fraction of Nike's revenue, and the company lacked the digital capabilities that have since transformed its business. Using a discounted cash flow model for 2010, assuming an FCF of $1.7 billion, an annual growth rate of 8%, and a discount rate of 10%, Nike's intrinsic value at the time was approximately $37 to $40 billion. The company's market capitalization hovered around $35 billion, meaning it was trading close to its intrinsic value. For Buffett, this lack of meaningful margin of safety would have been a deal breaker. This cautious approach is centered on buying stocks only when their price is significantly lower than their intrinsic value, providing a cushion against potential risks. Add to that his uncertainty about the durability of Nike's competitive advantage in a fiercely competitive market, and Buffett's decision to sell seems reasonable. Fast forward to 2023, and Nike is a different beast altogether. With revenue surging to $51 billion and net income reaching $6 billion, Nike's free cash flow has jumped to an impressive $6.7 billion. The model to DTC sales, now accounting for 42% of its total revenue, has fundamentally changed Nike's business model. By selling directly to consumers through its stores and online platforms, Nike has not only increased its gross margins to 43.5%, but also gained greater control over its brand and customer relationships. This transformation has made Nike more profitable and strategically resilient company, something Ackman likely sees as a significant long-term advantage. The current intrinsic value is estimated at approximately $88 per share. With Nike's current stock price at $75, the company appears undervalued by about 14%, offering a margin of safety. This is a stark contrast to its valuation of 2010, when the stock was trading close to its intrinsic value, leaving very little room for error. Ackman's decision reflects a different perspective. While Buffett prioritized avoiding uncertainty, Ackman sees an opportunity in Nike's transformation into a more efficient, profitable, and globally diversified business. Nike's current undervaluation, relative to its intrinsic value, provides an additional layer of confidence for Ackman's investment. This highlights how two different investment philosophies, Buffett's focus on simplicity and Ackman's embrace of growth potential, can lead to very different conclusions about the same company. Both approaches are valid, but the key is aligning them with your own goals and understanding of the business. The differing views of Warren Buffett and Bill Ackman on Nike offer valuable lessons for investors. Buffett sold Nike in 2010 when it was fairly valued, prioritizing simplicity and avoiding uncertainty. Today, Nike is presenting a potential undervaluation of about 14%. For individual investors, the key takeaway is understanding intrinsic value and aligning decisions with your risk tolerance. If 14% aligns with your risk tolerance, then it is a buy for you. If not, then there is no need. Want to know what Buffett is buying right now? Click the video on the screen to find out.